Today we're talking about the relationship between government debt and interest rates, why it matters, and what it means for consumers, businesses, and the government. The government debt, currently the government debt across all outstanding issues, it's about $31 trillion with a T. So the government's got about $31 trillion of debt, and it's been rising, as we know, over the last several years.
And right now in 2022, it's what, 400 billion or just shy of it?
Yeah. So for fiscal year 2022, we're estimating about $400 billion just to service the debt. That's not to pay down any of the principal, that's just to cover the service of the interest on an annual basis.
When we got our mortgage, we were thinking, how much can we afford? And in those first, 20 years of your 30-year mortgage, it's an interest payment.
Yeah.
And I think that's what we were saying before, is that there's a $400 billion a year interest payment on that outstanding government debt.
Yeah.
And that it's all, not all, but it's coming due on sort of a fixed schedule.
Yeah, as those are coming due, they're needing to get refinanced, and again, at a higher rate. But really the good news in all of this, with the yield curve getting higher, is that now investors in buying into new bond investments are finally able to get yields that really we haven't seen for a long time.
You can, as an investor, you could put money in those treasuries or in those bonds, even at a 6-month or a year out, and get the same return as those putting it in at a 30-year.
Look at the treasury yield curve. What's measuring is short-term treasury investments, the yield on those investments, all the way out to long-term treasury. So compare like a 3-month to a 30-year. And right now, as you mentioned, they're all about 4%. The yield curve is very flat. That's pretty unusual. Normally we see an upward sloping yield curve such that investors would be more incentivized or compensated for taking on longer-term bonds, for buying longer-term bonds.
Yeah, that makes sense. The further out you go, the more risk you're taking. Now, if you're on the other side of that, if you're the government and you need to make interest payments on those bonds, if that interest rate's going up, that can be a more difficult situation.
You've got the Federal Reserve that's very aggressively increasing short-term interest rates, and that's causing other parts of the yield curve to go higher as well. And one thing that's important is that, and this is it's human nature, I always think that where we are today is where we're always going to be, and that if rates are going up right now, that they're always going to go higher. If inflation is high, it's always going to be high, and that just won't be the case. We know that the markets go through different cycles and periods of time, and with the Fed and their actions now and how much rates have gone up, we do think they're getting to the point where there's going to be somewhat of a maybe artificial ceiling on how high interest rates can go. It's going to at some point slow down the economy enough that inflation starts to dissipate. And it'll also leave room for that ultimate kind of Fed pivot to reduce rates to, again, then spur economic growth in the future. Either way, though, we look at it as interest rates are probably going to hit some high point. We're probably not too far from that, if not already, to where we start to see interest rates start to kind of cap out. Again, a lot of it comes back to, we believe, just with how much and how expensive it is to finance some of this debt, that there's going to be a lot of incentive to not let that get too high. The other thing we look at in terms of the cost, so the average interest rate on the current treasuries that are outstanding. So take that 31 trillion, and we can solve for it, say, okay, how much is the average interest rate on that? And right now, it's been about 2.07%. That's the current interest rate on all that debt outstanding.
Yeah, altogether.
Yeah.
Right, but if you look at it as what do we owe in 30-year versus what do we owe in 10 versus 6 months? Yeah,
good. To that point, when you look at how the Treasury, the government, finances its debt, now a lot of times we refer to bonds as it's just a widespread kind of generic or broad term. But really, when it comes to treasuries, we really kind of get a little more narrow, and we break it up into treasury bills. Treasury bills are the shortest term. They're typically from 0 to 12-month in term. Treasury bill. And then next you would have a treasury note. Notes are typically 2 to 10 years in length. And the longest one is a treasury bond. That's typically that's typically over 10 years. Commonly that 20 and 30-year bond. Now, what's interesting about the debt and the interest cost is it's about right now it's about 15% of all that debt outstanding is in that short-term treasury bills. Okay, so why does that matter? Well, these are coming due, and the government's having to refinance all this debt that's coming due.
It sounds like kind of the comparison between a fixed year, 30-year mortgage or a variable rate. And so now that we had that that bond rolling off or coming due, as you say, that it has to be refinanced or repaid for
Yeah.
at a new, much higher rate.
Yeah. And you think about, okay, what are the ways that we can kind of fix it or reduce it or kind of navigate out of this? And there's kind of limited kind of suite of kind of potential options. One, if we can make the economic pie larger through growing the economy more, making it a larger, more valuable economy, thereby helping pay down some of the debt, or at least covering the interest costs. And the other option is cut spending, right? That's a hard thing to talk about. It doesn't get advanced very much. And here we are ahead of an election, midterm elections, right? We know we can kind of go through the revenues and expenses of the government and see, okay, how much is spent on these different line items, and not necessarily change the total spent, but just change how it's being spent and where it's being spent.
It's all really great information.
Yeah, thanks Ezra for being here as well.